Hi, I'm Dr. P. Vasavilata, working as Assistant Professor, the Department of Business Management, RBVRR Women's College. Today, our topic for discussion is evolution or history of Indian banking sector. Indian banking sector forms a major basis for economic development of the country. Indian banking sector has undergone major changes over the years with the advancement of technology, taking into consideration the needs of people. Indian banking sector has its history which date back before India got its independence in the year 1947. But talking about banking services, they have been into existence in India since ancient times. Indian banking sector development is divided into three phases. Phase 1 is the pre-independence phase which lasted from 1770 to 1947. Phase 2, known as the nationalization phase or the post-independence phase, which lasted from 1947 to 1991. Phase 3 is the liberalization phase or the banking sector reforms phase, which began in the year 1991 and continues to flourish till date. We will learn it in a phase-wise manner. Pre-independence period, which lasted between 1770 to 1947, comes up with the establishment of first bank in India, that was Bank of Hindustan, which was established in the year 1770, and it was located in the then capital of India, that was Kolkata. However, this bank could not survive in the market and ceased its operations in the year 1832. During the pre-independence era, more than 600 banks have been registered in the country, but only few of them could manage to survive in the market. Following the path of Bank of Hindustan, various other banks were established in the country during this phase. They were General Bank of India, Oudh Commercial Banks, Bank of Bengal, Bank of Bombay, and Bank of Madras. Now, talking about the pre-independence era, during the British rule in India, East India Company has established three banks known as Bank of Bengal, Bank of Bombay, and Bank of Madras. These three banks put together were called as presidential banks. These three banks were later merged into a single bank in the year 1921, which was called as the Imperial Bank of India. Imperial Bank of India served as a country's central bank from the period 1921 to 1934 till the Reserve Bank of India Act came into existence. But in the year 1955, the Imperial Bank of India was nationalized and it was renamed as the State Bank of India, which is currently the largest public sector bank in the country. Now, the banks which were established during the pre-independence period in India were Allahabad Bank, which was established in the year 1865, Punjab National Bank, established in the year 1894, Bank of India, established in the year 1906, Central Bank of India, established in the year 1911, Canara Bank, established in the year 1906, and Bank of Baroda, established in the year 1908. The reasons why out of those 600 banks, only few banks could survive into the market is they are prone to a lot of drawbacks, like there were a lot of fraud prone, that is there was no fraud detection mechanism working at that time. There were lack of machines and technology which increased the workload of people who were actually involved into the banking activities. There were a lot of human errors and it was a time consuming process because everything was recorded manually into the books, and there were fewer facilities available. That is, if a customer wants to avail a banking facility, he has to physically visit to a bank and perform all the procedures, and lack of proper managerial skills was the major reasons for the failure of majority of banks during the pre-independence period. Following the pre-independence period was the post-independence independence period, which observed some significant changes in the banking scenario and has still date developed a lot. Now, here comes the next phase, that is the post-independence period, which lasted from 1947 to 1991. As we all know, India got its independence in the year 1947. Before the Britishers hand over the freedom to India, one of the uh, rule that was kept in front of the Indian freedom fighters was The Hilton Young Commission has come up with a recommendation that if India establishes a central bank free from all political influences, they were ready to transfer the freedom from the hands of Britishers to the hands of Indian government. So, in establishment of Reserve Bank of India in the year 1934, it was established under the Reserve Bank of India Act 1934, but it's officially started its operations on 1st April 1935. So after the Reserve Bank of India was established and was successfully operated for a period of 10 years, the Britishers have decided that they would transfer the independence from British rule to the Indian government. At the time when India got its independence, all the major banks of the country were in the hands of private individuals, which was a cause of concern because people belonging to rural areas were still dependent upon money lenders or landlords for their financial requirements. With an aim to resolve this problem, the then government decided to nationalize the banks. The then Prime Minister, Mrs. Indira Gandhi, decided that the ownership from these private individuals will be transferred to the government, which was called as the process of nationalization. These banks were nationalized under the Banking Regulation Act 1949, whereas the Reserve Bank of India was nationalized in the year 1949. Now, following with its formation, the State Bank of India was nationalized in the year 1955, whereas the other 14 banks were nationalized between the time duration between 1969 to 1991. These banks which were nationalized, the 14 banks which were nationalized during that period, had deposits worth more than 50 crores. Each bank had deposits worth more than 50 crores. Now, what are the 14 banks which were nationalized between this period was Allahabad Bank, Bank of India, Bank of Baroda, Bank of Maharashtra, Central Bank of India, Canara Bank, Dena Bank, Indian Overseas Bank, Indian Bank, Punjab National Bank, Syndicate Bank, Union Bank of India, United Bank, and UCO Bank. These were the 14 banks which were nationalized during this period. In the year 1980, another 6 banks were nationalized, taking the number of banks nationalized to 20. These banks included Andhra Bank, Corporation Bank, New Bank of India, Oriental Bank of Commerce, Punjab and Sindh Bank, and Vijaya Bank. Now, this was a phase wherein majority of the private sector banks which were in the hands of the private individuals were nationalized and converted into a public sector bank where the majority of the ownership will be held by the government. Now, talking about the post-independence period, apart from the 20 banks which got nationalized, there were 7 subsidiaries of State Bank of India which were nationalized in the year 1959. These 7 subsidiaries are, they are called as the associate banks of State Bank of India, State Bank of Patiala, State Bank of Hyderabad, State Bank of Bikaner and Jaipur, State Bank of Mysore, State Bank of Travancore, State Bank of Saurashtra, State Bank of Indore. These are the 7 associate banks of State Bank of India. All these banks were merged into the State Bank of India by 2017. State Bank of Saurashtra was merged in 2008, whereas State Bank of Indore was merged in 2010. Now, what is the impact of this nationalization on Indian banking sector is, there were various reasons why government has to choose the nationalization of banks, because one major reason was to provide a kind of surety or assurance to the public deposits. Second was rural sector was completely ignored. All the banks that were established were only established in the urban areas. Rural financial assistance was completely neglected. So in order to overcome these problems, nationalization has come into picture. Now, what is the impact of nationalization on Indian banking sector is, this led to increase in funds, which in turn led to increase in economic conditions of the country. That is, with the nationalization of banks, more funds came into existence, country's economic conditions improved. Not only that, it helped in boosting the rural and agriculture sector, which was ignored till that time. It has opened major employment opportunities in the country. The government used the profits gained by from these banks for the betterment of the people, right? And the competition decreased, which resulted in increased efficiency. This post independence phase was the one that led to major developments in the banking sector of India and also in the evolution of the banking sector. The last phase is the liberalization phase, which is also called as banking sector reforms phase, which started in the year 1991 and is still flourishing. Now, once the banks were established in the country, they, their regular monitoring and regulation need to be followed in order to make sure that they continue the profits provided by the banking sector. The last phase, which is called as the liberalization period or the ongoing phase of banking sector development, plays a huge significant role. In order to provide stability and profitability to nationalized public sector banks, the government decided to set up a committee under the leadership of Sri M. Narasimhan to manage the various reforms in the Indian banking industry. The Narasimhan Committee came up with the major recommendations stating that the majority trust of the recommendations was to make banks competitive and strong and comprehensive to stabilize the financial system. So the committee suggested that there would be no more nationalization of banks because the majority of the banks were already nationalized. The committee also recommended that foreign banks could be allowed to open offices in India either as branches or as subsidiaries. In order to make banks more competitive, the committee also suggested that the public sector banks and the private sector banks should be treated equally by the government and the Reserve Bank of India. It also emphasized that banks should be encouraged to abandon the conservative and the traditional system of banking and adopt progressive functions such as merchant banking, underwriting, retail banking, etc. Now, foreign banks and Indian banks are permitted to set up joint ventures or other new forms of financial services with the Narasimhan Committee recommendations. Now, the biggest development after the Narasimhan Committee recommendation was the introduction of private sector banks in India. Reserve Bank of India gave license to 10 private sector banks to establish themselves in the country. These banks included Global Trust Bank, ICICI Bank, HDFC Bank, Axis Bank, Bank of Punjab, IndusInd Bank, Centurion Bank, IDBI Bank, Times Bank, Development Credit Bank. Now, the other measures that were suggested by the Narasimhan Committee were setting up of branches of various foreign banks in the country. No more nationalization of banks could be done. The committee announced that Reserve Bank of India and the government would treat both public and private sector banks equally. Any foreign bank is now permitted to establish a joint venture with Indian banks. Payment banks were introduced with the development in the field of banking and technology. Small finance banks were allowed to set their businesses or branches across India. A major part of Indian banking sector moved online with internet banking and apps available for fund transfers. These were the major recommendations which led to the development of what banking sector we look at today. Today, Indian banking sector is advanced with the latest technologies, right? Today we have internet banking, online banking, mobile banking, right? Doorstep banking, which makes the banking operations even more effective by abandoning the conventional or the traditional methods of doing the banking business. Yes, we will continue with the structure of Indian banking system. The Indian banking system consists of Reserve Bank of India, commercial banks, cooperative banks, and developmental banks. These banks act as an intermediary party between the people who have money, who are the savers, and the people who need money, who are the lenders or borrowers. This banking sector forms the core of India's financial sector because they mobilize the resources and use them through better allocation. Banks play an important role in the development process of the underdeveloped countries. If you look at the Indian banking system, you find the Reserve Bank of India on the top, which is considered to be the apex or the central bank of the country. It is further classified into scheduled banks and non-scheduled banks. Scheduled banks are further declassified into public sector banks, private sector banks, foreign banks, and regional rural banks, whereas the cooperative banks are further divided into urban cooperative banks and rural cooperative banks. Coming to the first classification, that is Reserve Bank of India, the country had no central bank prior to the establishment of Reserve Bank of India. Though Imperial Bank of India served as a central bank for the country for a specific time period, but it was never given a status of the country's central bank. The Reserve Bank of India is a supreme monetary and banking authority in the country, and it controls the entire banking system of the country. It is called as Reserve Bank because it keeps the reserves of all the commercial banks. The Reserve Bank of India is the country's central banking institution which controls the monetary policy of the country's rupee. It was established under the Act of Reserve Bank of India Act 1934, and it started its operations from 1st April 1935. Though it was established in the year 1934, though the act was enacted in the year 1934, it officially started its operations in the year 1935. It is considered to be the apex or the highest decision making body in terms of Indian banking system. It is headquartered in Mumbai. It has the authority to control the Indian monetary system. It supervises the Indian financial system. It acts as an issuer of currency. That is, only Reserve Bank of India is assigned with the responsibility of printing the currency in the country. It acts as a banker to the bank. It acts as a banker to the government, and it is entrusted with the responsibility of maintaining the financial stability in the country. Next classification is scheduled banks. Scheduled banks are the banks whose name appears in the second schedule of Reserve Bank of India Act 1934. Now here comes the question, what is there in that second schedule of Reserve Bank of India Act? See, if you fall under the category of second schedule of Reserve Bank of India, there must be a paid up capital and reserves which should not be less than 5 lakhs. All the activities of these banks should not cause any kind of damage to the depositors. That is, they will act in accordance with the interest of the depositors, and these banks should be registered as a corporate body or a cooperative societies, but they cannot be sole proprietors or cannot enter into partnership business. So any bank which follows these guidelines can register themselves into the second schedule of Reserve Bank of India Act. Any bank whose name does not appear in the second schedule of Reserve Bank of India Act, or any bank which does not maintain those three guidelines, can be named as the non-scheduled banks. Scheduled banks have certain privileges or advantages over the non-scheduled banks. Scheduled banks are the banks which become eligible for loans or which become eligible for debts on bank rate from Reserve Bank of India in cases of emergency. Such banks automatically acquire the membership of a clearing house, that is, they become the members of the clearing houses. Whereas non-scheduled banks are not eligible to borrow funds from the Reserve Bank of India for their normal banking purpose except for emergencies. Whereas scheduled banks are further divided into commercial banks and cooperative banks. Coming to what does commercial banks mean? They are the banks which mainly deal with commercial banking operations. Like the major primary functions of a commercial bank are accepting of deposits and granting of loans to the public. These commercial banks are further classified into four types. One is public sector banks. Public sector banks are those banks where the majority of the stake are owned and controlled by the government. All the nationalized banks and the regional rural banks are public sector banks. Examples of public sector banks are State Bank of India, Canara Bank, Andhra Bank, Union Bank, etc. Coming to private sector banks, private sector banks are banks where the majority of the stake or equity is in the hands of private individuals or business houses. There are few private sector banks in India like Axis Bank, HDFC Bank, Kotak Mahindra Bank, ICICI Bank, etc. The further classification of commercial bank is a foreign bank. Foreign bank is a bank that is headquartered outside the country but runs its offices as a private entity in any other location outside the country. Such banks are under the obligation to operate under the regulations provided by the central bank of the country as well as the rules prescribed by the parent organization located outside India. Foreign sector banks are the banks who have their headquarters located in the foreign country, but they operate in the country through subsidiaries or branches. An example of a foreign bank in India is Citibank. Coming to regional rural banks are government banks operated at a regional level in different states of the country. They are designed to cater to the needs of the people in rural areas. These banks help to bring the financial inclusion at the primary level. Currently, there are 43 regional rural banks in India. RRBs are jointly owned by the central government, state government, and the sponsored bank. The example of a regional rural bank is Telangana Grameen Bank. Coming to cooperative banks are the financial entities that belongs to its members. That means the members are the owners as well as the customers of that bank. They provide their members with numerous banking and financial services. Cooperative banks are primarily the supporters for agriculture activities. They are the supporters for small scale industries and self-employed groups. An example of a cooperative bank in India is AP Cooperative Bank. Cooperative banks are further divided into two categories: urban cooperative banks and rural cooperative banks. Urban cooperative banks cater to the needs of the urban people, whereas the rural cooperative banks cater to the needs of the rural people. Thank you.